So it's no surprise, since we're probably at a bubble peak now, that we're seeing a deviation or an error 12 years ago. The bottom line, though, is it's showing around a minus 1% return, nominal, on a balanced portfolio. That means if you put $100,000 into a balanced portfolio, you're going to have less than $100,000 12 years from now. And that's including the total return. Hello, everybody. It's Mike Preston at New Harbor Financial Group. It's Wednesday, March 20th, 2024, with a weekly update. I wanted to talk a little bit this week about Warren Buffett and Berkshire Hathaway and the mountain of cash that they're sitting on, and talk about why that is likely the case. Also, I'd like to just touch base on things that we think make sense here, both cash and real assets, and plus a couple sectors that we think are actionable. And these are ones that we took some positions in. Lastly, I'd just like to wrap up with a quick look at the S&P 500. Let's take a look at this article here. This article basically says Berkshire Hathaway has $168 billion in cash. Then it talks about some stocks that should be on your buy list. But what I want to hone in on is the fact that Berkshire Hathaway has $168 billion in cash. This is more than they've ever had before. It was a couple years ago that I think that number crossed 100 billion, but this is by far a record number. And so one can only think, and this is what I think, is that there's a dearth of good buys out there. The valuations in the market are extremely high. I'm going to take a look at a chart, show you a chart in just a few minutes about why that's the case, and just so you can see how extreme it is. And I know it's been that way for a long time. I guarantee you it will change at some point. It seems like we've been at a higher plateau for longer than ever before, but history always shows that bubble valuations don't last. It's a bit of a faith situation where we have to think that it's going to matter again someday, and I'm sure it will. Nobody knows exactly when. If I had to guess, I'd say this year, based on things that we see. We're in a presidential election year, and we happen to be, I believe, in the final years of a fourth turning. So it would be no surprise to me that we would start to see things heat up as we get closer to the election. But we'll see. We can't make predictions. Nobody knows what the short-term timing is going to look like. Why does Berkshire Hathaway hold all this cash? Well, it's because of valuations. By the way, I thought I'd slip in a little bit of a feel-good article here next, which I read last week and I thought was pretty neat. This school, the Albert Einstein School of Medicine in New York, got a $1 billion gift. The woman's name was Ruth Gottesman. Her husband was an early friend of Warren Buffett and held that stock their entire life. She didn't even know about it until after he passed, and the article says. And then she's, I think, 96 years old, and she gave $1 billion to this school where she was a professor at for a lot of years. And the news is that the students will never have to pay tuition ever. Current students are going to get refunds for their current semester, and no student will pay tuition going forward ever. That's a feel-good story. I think that was pretty neat. Warren Buffett obviously is a legend, and anyone that's invested along with him has been very smart to do so. But still, the fact of the matter is he's holding $168 billion in cash. We want to know why. The reason why is this. Take a look at this valuation chart. This is put out by John Hussman, someone whose work we respect quite a bit. This is a chart of non-financial market capitalization divided by corporate gross value added. This is very similar to stock market capitalization divided by GDP. This chart goes back 100 years, and you can see that we're at the tippity top of the most extreme readings we've ever seen. That's tough because for most of the last 10 to 15 years, we've been stuck here. And frankly, I could say since the year 2000, we've been stuck at relatively high valuations, with a couple forays to try to correct these overvaluations, one in 2002 and the other one in 2009. Each of these have been rescued by interventionist central bank policies and money printing. So we really haven't seen a clearing event. So we've been stuck at permanently high plateau, so much so that it seems like folks think we're going to stay there forever. I don't think that's the case. I still don't know what the catalyst is going to be, but I don't think we're going to stay here forever. If you take this valuation metric, you invert it, and you plot it against subsequent S&P returns on a balanced portfolio over the following 12 years. This is estimated 12-year annual total return on a conventional 60-30-10 mix. This is your conventional balanced portfolio. This model, too, goes back 100 years, and it shows the valuation metric that we just looked at plotted against what we can expect the market to actually do. You can see that the correlation is very good, except for a couple errors, which are highlighted in yellow. Now, these errors essentially happen to be 12 years before bubble peaks. So it's no surprise, since we're probably at a bubble peak now, that we're seeing a deviation or an error 12 years ago. The bottom line, though, is it's showing around a -1% return, nominal, on a balanced portfolio. That means if you put $100,000 into a balanced portfolio, you're going to have less than $100,000 12 years from now. And that's including the total return. So it's a bad situation. What it doesn't show you is what that path is likely to look like. We might have a drop of 50% followed by a claw back to even. We don't know. But that's not to say we're not doing anything here. We are about 45% in treasury bills, and we're up to around 38% in stocks, maybe 35 to 40% on average. There is some dispersion amongst accounts, and we're always looking for charts like this. This is a long-term point and figure chart of software. So what we're always looking for is bases, cups, if you will, and handles, and then a breakout, consolidation and breakout. This is a small position in the model right now, software. Another one would be healthcare. Now, each one of these white sections inside of these gray lines is a year. So this chart goes back many, many years. But here's healthcare. Healthcare based out for a couple of years and just broke out to a new high. These are the types of things we're looking at. So we've got a 2.5% position here, 2.5% position here. We just took off positions in industrials. It was a 5% position, a nice profitable position, and a 2.5% position in insurance. But long story short, we're 35 to 40% in stocks, and we've got hedges that are pretty tight. I'm going to finish up by pulling up a chart of the S&P here. We continue to have a hedge of around 15% notional. So if you accept that we have maybe 35% stocks on board and a 15% hedge down at 4,700, that means if we get a big drop or a crash down below there, we instantly go from 35% to 20%. So that's about a 10% deductible or so, which would bring us down to about 20% exposure. That 20% has additional hedges on board. So all of that is to say that we don't have zero exposure or zero risk. We would almost certainly see a loss of a few percent if we had a crash, 20 or 25%. But we're doing the best we can to continue to work this hedge higher. If we get a move higher, and I think we probably will, get a breakout higher. In fact, we're trading at a new all-time high right now at 5197 at 5 minutes past 2 Eastern. On March 20th, the Fed just announced something, and it looks like it might be short-term positive. And so we're basically flirting with 5,200 right now. And actually, we just printed it. So we'll see. We probably go a little bit higher. And if we do, we will continue to move this hedge higher so that hopefully we get some kind of drop or crash from a higher level and that our deductible is not that meaningful. But it's been great to share with you. I guess I would also say one last thing before we close. Don't forget that we continue to value cash. We're about 45% in treasury bills and cash equivalents and real assets. About 5 to 10% in gold and silver. We recommend ideally in your possession. And things like real estate can work here if you can avoid the bubble areas. Happy to talk to you about any of these things. Give us a call or an email. Happy to answer any questions that you have. And we'll continue to try to tell you what we're doing every week here. We hope that things get a little more interesting. We hope that we get some more opportunities. Gold and silver seem to be doing well, and miners are certainly starting to participate, which is a good thing. So we hope that continues. Until next week, this is Mike Preston at New Harbor Financial. Thank you. See you soon.